The Series Seed provides a very practical approach for doing an equity investment in an early stage company. We'll explain the key terms of the Series Seed in this video and the documents that are involved. And then at the end of the video, we'll talk about the pluses and the minuses of using the Series Seed as an investment mechanism for an early stage startup. Hi, I'm Steve Morris, and I use this Startup SOS channel to provide practical how-to advice for first-time entrepreneurs. So today's topic, the Series Seed. In earlier videos in this series, we talked about convertible securities and why they're very popular as early stage funding mechanisms for startups. Securities like a convertible note or a safe. The reason that the convertible security is attractive is it's very simple, simpler than certainly a priced equity round, relatively few terms to negotiate, and as a result, it's lower fees. It's a pretty short legal document in general. But what if there were a way to agree upfront on a standardized set of terms for a priced equity investment with just very few terms to negotiate? Well, that would also make things more simple and keep down the legal fees. And that's exactly what happens with the Series Seed. Series Seed is a simplified set of equity investment documents with relatively few terms. These documents were put together by some attorneys from Fenwick and West. However, it's not something that's supported by the law firm. It's an open source project. The goal being to provide a practical, affordable approach for a equity investment in an early stage company. There are 4 documents in the Series Seed collection: the term sheet, the restated articles of incorporation, the purchase agreement, and the investor rights. Now, those documents taken all together are 54 pages. That's certainly a lot longer than the typical documents you would see for either a convertible note or a safe, either the pre-money or the post-money safe. However, they are somewhat simplified. A normal equity investment round would easily involve 100 plus pages of documents. They simplify things by taking out a number of terms that really aren't relevant to an early stage financing, and we'll go through some examples of that. Let's start with the term sheet. Now, the very first thing in the term sheet is a statement that it is not legally binding. It's merely a document for coming to agreement on an equity round. However, there is one exception. There's one paragraph that is binding at the end. We'll get to that. Starting at the top with the financial terms, of course, it states that there are some number of preferred shares to issue. Now, preferred shares are simply shares that are going to have some special rights beyond those rights that the common shareholders have. And we'll cover a number of those as we walk through the term sheets and the documents. Of course, it specifies what amount is being raised. What is the pre-money value for the company? How big of an option pool percent is being allocated prior to the investment? And then finally, what is the share price for the round? Now, the percent of the company that's being set aside for an option pool is one of the key terms that the entrepreneur needs to pay attention to. The investors want to make sure that you've allocated options such that you'll be able to compensate the employees that you'll be hiring, as well as compensating board of directors members, board of advisors members, and even vendors. The trick is you want to allocate enough options for that, but not too many options, because whatever you allocate up front for the option pool dilutes the founders. It doesn't dilute the Series Seed investors because those get allocated before they make an investment. So you need to do your homework. You need to think through how many options do you actually need? How long will this funding round fund the company? And over that period of time, how many employees will you have to compensate, and how much stock will be needed to do that? Same with directors and advisors and so forth. So once the option pool size is determined, then you know the total number of shares, the fully diluted number, i.e. issued shares plus those allotted for an option pool. And then with a pre-money valuation, you can calculate the price that investors will pay. Next term, liquidation preference. This basically says in any kind of a liquidation event, including an acquisition, investors in the preferred shares have the option of simply being paid 1x of what they invested. Now, remember, as we'll talk about in a later term, they'll always have the option of converting their shares into common and participating with common. And if it's an acquisition and the valuation on the acquisition is very high, such the common shares are going to get paid a lot, then that's what the investors will do. But if it's not a very high valuation, or let's say the company is shutting down, but there's some cash left, well, then investors are going to go for their 1x preference. They get paid what they invested, if there's that much money available, before the common shareholders see anything. So the investors get to choose which way to go in the case of liquidation. That's one of the key special rights that a preferred shareholder receives. As we just mentioned, there's the conversion term. At any time, a preferred shareholder has the right to convert their preferred shares into common shares. And of course, that would typically happen in the case of an acquisition where the acquisition price is attractive enough that it makes more sense to do that instead of to use their 1x liquidation preference. Next term, voting rights. This is another one of the key special rights that preferred shareholders have. They basically have the right to vote as a class, just the preferred shareholders, to approve or not approve, essentially to veto, some key actions that the company might want to take. Those include any change to the rights of the preferred shareholders. They get to vote on that before it goes into action. The number of shares outstanding, if that changes, they get to approve that. New preferred shares being issued at the same rights level or more rights than what they have, they get to approve that. The repurchase of shares, if the company's looking at repurchasing shares, they get to approve that. Declaring a dividend, something that generally does not happen in a seed situation, but were that to happen, were the company to want to do that, they would get a vote on whether or not that's okay. And then finally, the liquidation, a vote on any kind of a liquidation, a shutting down, an acquisition, and so forth. They get to approve or disapprove of that. So those are some very important key rights that preferred shareholders have. Those kinds of rights are why a company is losing a lot of control when it takes investor money. These are some pretty key veto powers, essentially, that the preferred shareholders have. So keep in mind, even if you're only selling 10 or 20% of your company's stock, that still is providing a lot of control to the preferred shareholders. Good thing to keep in mind. The documentation term simply says that the documents will be identical to the series seed. In other words, no changes. The only things that will be edited are the fill-in-the-blank terms, such as the option pool size, the price of the shares, and so forth. The financial information term simply says that major purchasers have the right to inspect the books, and they get a management right letters. Now, what's a major purchaser? Well, that's defined in the term sheet as an investor who invests some minimal amount. If an investor invests less than that, they don't get these inspection rights or the management rights letter. More on the management rights letter and what the heck that is, coming up in a minute. The participation rights term says that the preferred shareholders get the right to participate on a pro rata basis in subsequent investment rounds. So in other words, if they'd like to maintain their percent ownership, they have the right in future rounds to purchase additional shares. If they didn't do that, of course, the next investment would dilute them, along, of course, with the founders. So that is a key right for seed investors. What the term sheet says about board of directors is it defines how many directors can be elected by the common shareholders, how many by the preferred shareholders, and how many board members can be elected by agreement between the two groups. Now, for example, it may say that the common shareholders get to elect one board member, the preferred shareholders elect one board member, and then jointly they agree on a third board member that would probably be an independent member, i.e. somebody who's not an employee of the company, but also not one of the investors. So that would be a very common early stage board structure. The expense term simply indicates that the company gets to pay up to $10,000 of the legal fees for the investors. That's a very common term in an equity investment. Out of the proceeds, you get to pay for part of the legal expense for the investors. The future rights term assures the preferred investors that they will get the same rights as the next round of preferred shareholders. So that obviously can be an important protection to a Series Seed investor. Key holder matters. Now, key holder basically refers to founders who hold a lot of common stock. And the term sheet requires that there be a 4-year vesting of their shares. So in other words, if they opt to leave the company before 4 years is up, they'll forfeit at least some of their stock in the company. Obviously, that's meant to retain the key founders at the company. This term also requires that the founders, of course, assign their intellectual property to the company. And finally is the one paragraph in the document that is binding. And it basically says that for 30 days, the company shall not solicit other offers and won't share the details of the term sheet with anyone, except key partners and prospective investors. So it's trying to keep the company focused just on this particular investment opportunity over a 30-day period. That's the term sheet. Let's take a quick look at some of the key features in the other 3 documents in the Series Seed collection. So first, the restated articles. These are simply creating a set of articles that are appropriate for this type of investment that support some of the terms in the later documents. So what's unusual about the restated articles? Well, number one, there's no preferential dividends. In reality, you'd very rarely see dividends being paid in a seed investment round, but it's commonly boilerplate that's included in the documents. For the Series Seed, they simply remove that because for a seed investment, it's pretty much never happens. No redemption rights. A redemption right is the right of the investors to demand that the company pay them back, purchase back their stock. Now, that's typically something investors would want to do if things aren't going well, if the company management just doesn't seem to be taking seriously the management of the company, or the company's doing things that the investor really disagrees with. This is a way for the company, the investors rather, to really get the attention of management and say, hey, we're not happy. We want you to buy back our stock. The reality is, that's something you do when you want to sit down and seriously negotiate about what your concerns are, because most likely the company, of course, wouldn't have the funds available to actually buy back the shares. And finally, no price-based anti-dilution. That's referring to this idea of if in the future you sell stock at a lower price than what you sold stock to us, then we get that lower price. And there are different ways of calculating what they'll get. It could be what's called a full ratchet, in which case they get that price. Or it could be based on more of an averaging. If it was just a really small amount of stock you sold, then the impact on that would be minimal. All depends on the terms. But those kinds of anti-dilution terms are simply not in the Series Seed documentation at all. That leads us to the investor rights document. Some of the key things there that are missing would be there's no registration rights. A registration right would say when you go public, the company will do the appropriate registrations so that the preferred shareholders can sell their stock. Well, in a seed investment, going public is not a likely scenario, so that language got removed. Information rights are defined in the investor rights agreement, exactly what kind of information the company is going to provide in terms of quarterly financial reports, for example, that are unaudited, by the way. Then there's the right of first refusal. If a founder wants to sell some stock, the company gets a right of first refusal. What's missing is a very common term that would be the right to co-sell, a right of selling alongside the founder, typically not something that's going to happen in a seed round. And finally, there are some drag-along rights. These basically are saying if a majority of the large shareholders agree on some particular action, then the smaller shareholders have to agree to go along with that action. That leads us to the stock purchase agreement. What's a little unusual there, there are relatively few company representations. There are some, but relatively few compared to your typical equity documents. No closing conditions, which you would typically have a long list of closing conditions. And there are no officer's certificate, secretary's certificate, and no legal opinion. The legal opinion in particular is something that costs money for a law firm to spend time documenting all kinds of statements. And again, typically not a great fit for an early stage seed investment. Everybody knows it's high risk and the company is early on. So all of those things are not included in the stock purchase agreement. We mentioned earlier the management rights agreement. That's not one of the documents that is a part of the Series Seed standard set, but it's something that's referred to in the Series Seed documents and is a very common thing in an equity investment round. This basically applies to a fund that has an investment fund that's investing in the round that has pension funds investing in it. If there are pension funds investing in the fund, then ERISA requirements come into play. ERISA is the Employee Retirement Income Security Act. Basically what it says is a pension fund that invests in an investment fund that invests in startups has to have all kinds of onerous reporting requirements unless the fund they're investing in qualifies as a venture capital operating company. Well, in order to qualify as a VCOC, the fund needs to be active in management of the company. So it has to have access to information and access to management. And that's what the management rights agreement says. So it's simply a piece of paper, an agreement that a pension fund that invests in the investment fund needs to have in order to avoid those egregious ERISA reporting requirements. So why would you want to consider a Series Seed investment as opposed to a convertible security, either a note or a safe? Well, there are some pluses. Like the convertible securities, it's relatively low cost because everybody's agreeing up front on the set of documents. It provides very clear visibility of what your dilution is. You know exactly, with the stock options included, what's your pre-value money, what's the investment, what percent will the investors own, and what percent will the founders own at the end. And there are some investors that will prefer doing an equity investment as opposed to a convertible security. For similar reasons. They know exactly what part of the company they're getting in the investment round. So those are some of the pluses. Some of the drawbacks? Well, unlike a convertible security, the Series Seed does not delay the valuation. You're doing a valuation right up front. And a valuation in an early stage company is kind of a tricky thing to do. So there's an advantage in delaying that, and the company will be worth more. It'll get a higher valuation. So that's certainly a drawback of doing a Series Seed. Another drawback, you'll most likely end up with at least one investor on your board, a voting board member. In a convertible security investment, you may end up with an investor who's an observer on the board, but without voting rights. But with a Series Seed, there will be an investor who's voting, and the investors have special rights. So just in general, there's a lot of control lost with a priced round compared to a convertible security. And then finally, some investors just really aren't familiar with the Series Seed, with this idea of going with a standardized set of documents that's already preset may seem a little scary. A lot of investors are more used to doing either a safe or a convertible note for an early stage investment, and so it might be easier to close a convertible round instead of a Series Seed round. So there are pluses and minuses. Basically need to talk with your advisors and decide what approach is best for you. And that's a wrap for this video on how the Series Seed works. If this was helpful, please click like and share it with other entrepreneurs. And if you haven't subscribed yet, please click the button down there to subscribe. And after you do that, you can click the bell to get notified when we have new videos, because there'll certainly be more coming up. And remember, this is just one in a series of videos. There's a link to the full playlist right below me, so please check that out. And if you have any questions or feedback, please leave a comment. That's it for this time. Thank you very much for watching.